G'day, Fred. How are you?
You good, mate? Yourself?
Yeah, not too bad. Luckily, it looks like all of that wet weather has stopped and it's a bit drier now. So how's the ducks going on your pond?
You might have pretty good, but do you want to hear a funny story? We had some of the guys that were working on our factory had to get called away to a project down south, down in New South Wales, and they got caught on the wrong side of the floods, and so they couldn't get home. Well, the problem was one of the guys' wedding is tomorrow,
Oh,
and he's on the other side of the river, can't get through, so he's had to get a helicopter to get him, pick him up, and bring him home.
I hope he's taking his best man. I hope he doesn't forget his ring on the other side of the river, mate.
Oh dear. Anyway, so what are we talking about tonight, mate?
Look, what I thought I'd do is in some of the last YouTube episodes that we did. I'm just going to share my screen now, Fred. But I'll just in the last couple of YouTube episodes, we've gone through processes where we've used Algo Wizard to develop some simple trend following models, such as the using a Donchian breakout model in conjunction with a Bollinger retracement entry into trend model. And then we did that within the Algo Wizard environment. And then we took it into the custom projects environment of SQX and ran some comprehensive tests in the next video. And in the course of that, I got a few comments from some YouTubers out there, and I'd just like to respond in this video to some of those comments and also discuss what sort of the central messages that have been brought out by these comments. So I'll just show you a comment from a YouTuber called Christoph. Christoph looked at the back test that we undertook with GBP JPY that I undertook, and he commented that look, he's familiar with these style of back tests, and what he usually finds is that when these back tests are typically curve fit to past data, and as soon as you take them into the demo or live environment, they fall over. And we know that occurs. We've seen that a lot, you and and I totally understand where Christoph's coming from. However, that's something that we've specifically responded to in our method. And what Christoph suggests is that how about just to test the validity of the statement he's making, why don't we try that algorithm that we developed for GBP JPY on another market, and see if it stacks up. If it stacks up, then it might not be curve fit. If it falls over, it clearly will be curve fit. So
has he forgotten that we actually multi-market test these things before we put them out?
Yeah, look, I think he just saw the video without looking at the prior videos to understand the steps we've taken to eliminate the chances of a curve fit response. So I don't think he is probably familiar with our design-led approach for trend following, which significantly reduces our chances of having a curve fit response, and also is probably not aware of all of the extensive multi-market testing we do on these models and across different data sets to ensure that there is very little chance of a curve fit response. So just to confirm, for Christoph's benefit and others who might be thinking that these are the standard run-of-the-mill EAs that are generated that typically fall off the cliff as soon as you put them onto a different data source, I just want to, what I'll do is I'll run this GBP JPY model just quickly to show what we presented last night, and then I'll put it on a couple of different markets, and we'll do the walkthrough there. So
you might want to just move that little window out of the way so I don't have to look at myself. Thank you.
Mate, you're very handsome. I don't know why. Okay, so
you don't know why I'm handsome.
That's a good point. So we're using that GBP JPY model, and look, what we'll do is we'll quickly run through what we presented, or what I presented on the video yesterday, and this is a back test from 1980 up to the current day, using a composite arrangement of two trend following models. And we'll run this now. I'll just check that I've got all the settings correctly established. Won't be a sec. It's all looking good, and this is on the GBP JPY market. We're risking 0.2% risk per trade, and we've got 10 different EAs compiled into what we call a sub-portfolio EA, of which 5 are using the Donchian breakout and 5 are using a Bollinger retracement into trend. So we're ready to go. Let's run it. So here we go. So as you can see, with this process, I'll just slightly speed it up. So the way this model works is it's designed to particularly operate during more exotic trending environments. It is fairly dormant during sideways congesting markets, but it is targeting specifically trending environments. So if I put this on pause now, we see a significant reduction in price here. So this model is firing a large number of different trades short into this particular short trend. So this will be a composite of both the Donchian breakout and the Bollinger retracement into trend trades. But you see how it does tend to capture the trending environments well. If we go back to a long-term trending environment, you'll see we've got some very long-term trades here, but numerous trades attacking different trajectories of the trend. That's exactly how we've designed this EA. So during sideways congesting markets, we may have a few trades undertaken or being triggered, but in the main, we're particularly active during trending regimes, and you can see it here. So this is what we're doing here is what we refer to as a map to market phase, where we ensure that our EAs are only active during those regimes we want them to be active in, such as trending environment conditions. And you can see that it's obeying this quite well. So, Fred, anything you need to say here at this point in time?
No, you can see the way the EA's firing. Most of them seem to be on a breakout. There's just 1 or 2 going on retracement, but predominantly they look as though they're in the breakout scenario.
Yes, I think it's going to vary during the course of the different market regimes, but yeah, I agree. We often see a dominant when it's trending, clearly trending. We definitely see those the Donchians firing off.
Yeah, and when it starts to go a little bit sideways, is when we get the retracement entries. But you've got to be happy with what you see there. There's some really long-term, nice-looking trends.
Yes. Definitely, mate. So here, just to explain what's happening here, we've had numerous shorts, and if I go to
right in the middle of the page there, you've got a retracement entry by the look of it.
We've taken numerous short trades here, and our trailing stops are all trailing behind our positions. So we've built up on the right here. You can see the equity curve, the green line that's come up here. That means we're holding unrealized equity as we're in a short trade here, and we're building up our profits. I'll just go back to running it. So these ultimately will trigger out. Here we go. So you can see these trades being triggered out as they hit the trailing stops. I can speed things up. So we should get the idea now of how these EAs operate. I'll wait for a really nice trending condition and just pause it. We'll get some very nice long holds. To put this into perspective, these trades, this trade here was going from 2007, holding for multiple years, closed out in the August 2009. So there's over a 2-year trade there. So a lot of them have very long holding periods.
But that's what we're aiming for, isn't it? We're looking for those outliers that hang and linger for a long time.
That's right. Here's some very nice long trades holding for multiple years. Here are some shorter term trades. You can see we've got a range of we're attacking a range of different trend segments here with different EAs. This is the composite nature of this sub-portfolio EA, designed to attack it in many different ways.
But looking at the price chart itself, there are some really nice trending periods, which is why this EA is firing. So assuming that we can find other markets that have got a similar trending nature, this EA should work fine.
Exactly. We'll demonstrate that in a sec. You can see the equity curve is building beautifully, but what you need to remember is that it looks a beautiful equity curve, but this is over a very long time period. So we'll discuss this a bit later on about the need for patience with these models, because people's expectations when they start using these algorithms is that they should get instant gratification or instant benefit from them. Now, for these particular models we use, that is certainly not the case. You don't know when you get the windfall. They do occur over the course of this is, since 1980 up to current day, so there's 40 years here. Often there is many periods, protracted long periods, where you're slowly building drawdowns, nothing's really happening, and then you get these windfall periods when the markets start trending. So when we look at this, sorry, you go for it.
I was going to say it's probably not the subject of this discussion, but that's one of the reasons we're looking for the portfolio approach, so that when those long periods of stagnation occur, other EAs in other markets are picking up the weight and taking advantage of.
Yeah, exactly. So that was that EA was data mined for GBP JPY. Now, what we're going to do?
Throw up the report again, Rich. What does it look like? It's a pretty good profit factor.
Profit factor of 2.45, a drawdown of maximum drawdown of 13.7% over here. It's a good result.
Yep.
Now, of course, we could leverage this with a higher risk allocation. We'll discuss that later, but now what I want to do is just show how it's not curve fit. By changing the market, we're going to use exactly the same algorithm suite, and we're going to use it, for instance, on Euro USD. All I've got to do here is change the reference chart to Euro USD. And so we're using exactly the same algorithm, and I run that over the same 40-year period for euro dollar. So I'll just slow this down. So once again, when you get into these trending environments, it takes off. So here's some short trades here. So the EA is functioning exactly the same way, simply looking at trends, irrespective of the markets it's used on. So with our particular technique, we're using volatility adjusted normalization methods. That's a bit of a mouthful, but what it means is that we can apply these algorithms over any market, because all of our stops, all of our trailing stops, all of our methods of entry and exit are built around the notion of normalization. So they're not price dependent, they are ATR or range dependent, which therefore allows us to apply these to any particular market.
Yes, just to clarify that for people that might not fully understand that, if we've got a trailing stop of 5 ATR and we've got an ATR of, say, 100, that would mean we've got a trail of 500, whereas if we have another instrument which has got an ATR of 10, that trailing stop would be then effectively 5 times 10, which is 50. So that's what Richard was trying to explain, how it's normalised for that for the markets.
Exactly, mate. I'll show you the report for Euro USD. Very good profit factor, 1.97, maximum drawdown 15%. That's for Euro USD. Now, let's try it on. I'll try it on USD JPY. So this is just demonstrating for Christoph's purposes that it's not curve fit. USD JPY. Some great trends in here. Oh, pretty wicked market for trending.
Now, just because the EA works across multi-markets, we're still, in our process, trying to gear something up for each individual market, aren't we, Rich? Even though
That's right. All I'm doing is I'm demonstrating that these EAs, even though these EAs are configured for a particular market, they're robust and they can apply over any type of market data. So in other words, what we're saying is that we do data mine for particular markets using these trend following models. So we're honing them or sharpening them to specifically respond to a market, but they are generic in nature and can work over multiple different markets. This one, 1.7, drawdown 23%. But it just shows you that over different markets, these models are trend following in nature. They're not data mined to past market data.
Yeah, I think that's pretty clearly demonstrated there.
I think so, mate. Look, what I also want to show is that if I bring over now the what I've done is I've looked now at for these particular models. This one for GBP JPY was on a 0.2% basis, and it was compounding. So this was the equity curve we produced, and from 1980 up to current day, you can see that there is a very long stagnation period of multiple years. But you can see in this instance, when I look at the overview, you can see that our compound annual growth rate, well, this is a very low compound annual growth rate of 2% per year, but a maximum drawdown of 7% per year. Now, we've done this on an individual market GBP JPY at this level of position sizing or trade risk treatment, because we compile these with many other different markets, and when they're all brought together, you get the benefits of leverage. But I just wanted to show what happens if, for instance, we change the percent trade risk from, say, 0.2% for that model to 1% for that model. So with a 0.2% per trade in that model, just remember the 2% compound annual growth rate, the 7% or 8% drawdown. Now the 1% model generates a 9% compound annual growth rate with a 38% drawdown. If I look at the equity chart, it's a similar equity chart, but we get strong compounding effects towards the end. We still got a big stagnation period. But keep in mind this risk-adjusted metric called the CalMAR ratio. When we applied 0.2% risk, the CalMAR ratio was 0.25. As we increased the leverage on this solution to 1%, our CalMAR ratio slightly decreased. This is unfavorable for us. Even though it produces a higher compound annual growth rate and a much higher drawdown, the relationship between the compound annual growth rate and the maximum drawdown is not linear.
That's a function of the compounding, I imagine.
It is, mate. That's exactly right. But clearly, we would opt for more solutions of different markets with this level of leverage than more solutions at this level of leverage. That's to get the benefit of the compounded effect from our portfolio. It's just an interesting thing just for members to keep in mind. If we further increase the compounding to 1.5% per trade, we lift the compound annual growth rate to about 12%, which is great, but a commensurate 53% drawdown over the 40-year period. That's a heavy drawdown, and I don't know about our members, but that sort of would be testing my tolerance level. I don't know about you, Fred. When we've got significant capital at risk here, these high drawdowns can get quite unpalatable. What do you think, Fred?
Yeah, that's beyond my tolerance. But if you buy and hold on the S&P, that's the sort of numbers you're playing with.
Yes. Now, what a lot of retail traders do is they will apply something crazy, like they will max out their leverage. And let's have a look at a good example. Here we go. Let's say they traded with 5% trade risk. You ready?
Yeah, I can see it already.
All right. Now, the thing is, you'll see that they almost get 100% maximum drawdown, but their compound annual growth rate is compromised by over leverage. It's not actually achieving as high a compound annual growth rate, for instance, as this 1.5% trade risk. And that's because the compounded effect with highly leveraged models, and what I'll do is I'll show you what I mean. This is the equity chart of the highly leveraged 5% trade risk per trade using that same model. Now, what's happening with compounding is a process that occurs based on the equity at any point in time. And if you get significant drops in equity with these big drawdowns from highly volatile, over-leveraged solutions, the compounding effect spends most of its time in these low levels, not getting any benefit on the overall equity. So if you can reduce the leverage and get a more steady line going up to the right, the compounded effect progressively increases each time it compounds. Compound. But if you get these highly volatile series, you'll find that the compounding effect is diluted when you get significant drawdowns and does not significantly increase your overall net wealth. I hope I explained that okay.
Yeah, I get it. As a side note, when it hits $5 million, I'd be going home, I think. Turn it off and go home.
At this point here?
Yeah.
Yeah, we could have packed up then. We would have had, how many years there? Maybe about 4 years of, there, we've got our $5 million and we're in Bahamas. Okay, so that's something to understand. Also, what I did was I just wanted to show you now using these methods over multiple different markets. And the first thing I'm going to do is I'm going to show you the equity curves of the different markets. For instance, in this example, I've only tested this multi-method that for GBP, JPY, across across 6 different Forex markets.
So they're all using the same EA, is that right?
No, these I've data mined for AUD JPY, I've data mined for AUD USD, but I'm using the same trend following models, but data mined for each of these.
Okay, so unlike what we were testing before with multi-market with the same EA, this is EAs tuned for each individual market.
Yes, but just remember that each of these EAs are robust, just like the GBP JPY one was, and they would work on other markets.
Yes.
So these are the equity curves, and just to show the benefit we're getting from the offsets, the correlation offsets, and to understand that, if, for instance, we note here, this particular purple equity curve is entering a small drawdown or stagnant over this period here. But at the same time, this equity curve, we're getting a nice beneficial uplift in the equity curve. And so this general equity curve is slowly rising. This is slowly falling. These effectively offset each other at this interval here. And the way you look at this is the correlation offsets give you benefits across your portfolio. So your risk-adjusted return, the CalMAR of this series is 0.48. This is like the MAR ratio. The CalMAR is 0.48 simply because we put it over 6 markets. But if I look at the CalMAR on any of for instance, the 0.2% compounded that I did for GBP, JPY, 0.25, you'll see that we had lower risk-adjusted return performances using just GBP, JPY alone. But when I start bundling these together, the CalMAR significantly improves. So that's what we're talking about in terms of what we refer to as a risk-adjusted performance metric. This means that we get benefits, correlation benefits in our portfolio as our CalMAR or our MAR ratio improves. So that's something to show you here, but also what is important for us retail traders is to understand the realities of trading and what the best funds in the world are producing. So in this example, for instance, let's look at this example here where we produced a compound annual growth rate of 11%. This is a 1.5% compounded solution. We had a compound annual growth rate of say 12%, a maximum drawdown of 53%. Let's compare that to how the best funds in the world are doing. So what I've done here is I've got the best trend following funds in the world listed here, and over a 20-year period, so from the year 2000, and I've ranked them from the best compound annual growth rate to the worst. So using this column P here, which is a compound annual growth rate of all of these funds over a 20-year period, I've ranked them from highest to lowest. I've then taken the top 10 of these funds, 9, 10 here, these ones here, and I'll show you how they perform. So keep in mind, these funds are the best in the world. And the top performing fund at the moment is this one called Salus Alpha Capital. Let's have a look at that. Salus Alpha Capital. This particular fund here has produced a 14% compound annual growth rate over the last 20 years with a maximum drawdown of 20%. Sorry, mate?
Just, you might want to explain the curves there. What are we looking at?
Okay, so the yellow curve is the Salus Alpha Capital equity curve of the fund.
Right.
This top 10 here is the top 10 funds. Don't worry about that. This is the one to look at, the yellow curve here. You'll see it is fairly volatile, but it has been increasing. But you'll also see that it had a drawdown of about 21% over this period here. Its compound annual growth rate divided by its drawdown is 0.66. This is the top performing fund in the world. So when we come back to our results here, just to put it in perspective, we have a compound annual growth rate of around about 12% for, this is a 40-year period as opposed to a 20-year period, with a maximum drawdown of 53%, with a CalMAR of 0.22 as opposed to the 0.6 of the best performing fund in the world. Obviously, they're better than this result here, much better than us, but it's not too different. And this is important to keep in mind that it is exceedingly unlikely that you're going to survive if you over leverage your solutions to try and get more compound annual growth rate than what is achievable within sustainable drawdown levels. So that's why we need to be very happy with these results. Now, a retail trader who isn't patient, who wants everything today and wants a 100% return in a year, they're going to be over-levered and they're not going to survive as a long-term trader. If the best in the world can't survive as long-term traders with those levels of performance returns, it's very unlikely that a retail trader is. So it's often good to, as a benchmark, to use these fund performance metrics of the best in the world just to get a grip on reality and recognize what levels of leverage you should be working with for your own comfort level and to stay in the game for a long period of time. All right, well, sort of that was where I was going to leave it tonight. Anything?
Well, before you do,
yep.
Why don't you put the combined equity curve on that chart, just so we can see what the combination of those gives you.
Okay, so the combination, when we run it, that's the equity curve of the consolidated result, the blue line here.
Which once again demonstrates the benefit of diversification.
Absolutely, mate.
And you've got to be happy with that curve, surely.
Exactly. There's no severe points of drawdown over this curve. It's a good result, but you've got to be patient. Once again, this is a 40-year period. Here's a stagnation period of 1,600 days, which is multiple years where we're not producing anything. So, you know, when we look at the, let's go to the overview, and I'll look at something. Let's say we were happy with this one here. Let's look at this in terms of dollars. So with this particular 1% per trade option, we've got a compound annual growth rate of 9% with a maximum drawdown of 38%. This is sort of over a 40-year period, this would be the sort of risk tolerance I'd probably accept, this level here. But when we look at the returns, remember we start with a $50,000 balance. You see our first year was a loss year, second year profit, third year good profit, fourth year another fairly good profit. As we come up, we get multiple years of profits, but we do get multiple years of losses. Lots of red in here. However, when we do get big profits, we get big profits. This is 115,000 profit in 1990. In 1995, there's $41,000 profit there. $70,000 profit here in 1993. If we go up to the uncertainty periods of 2008, 2009 around the GFC, this is where we get big dollars, $285,000, because our models are targeting the fat-tailed areas of the market distribution of returns. So when markets get extreme, such as in the GFC environments, we should do well, which is evidenced by this very good profit result here. Exceptional profit here in 2016 with $777,000 profit for the year. Obviously, this is being compounded as we're going up, but we started with $50,000, and you can see that as our equity builds, our annual profits can be significant. But,
2016, 9 months of no profit at all, which is interesting. So that means that those trades that finally closed out were hanging in there for a long time.
Yeah, these trades were long holders. They were holding all over this period, and this is where that's why it was such a big 777,000. Obviously, they've latched onto very good trends in 2015. I'll just go to 2015 and see what was going on there. GBP JPY. I'll go to the weekly chart. So this when we this period here, this big significant drop off is what we're obviously holding trends for long periods of time, short trends. So yeah, it's very interesting.
But again, what you're looking at on the screen right now is one currency pair. If you go back to your portfolio and have a look at the dollars on that, how does that?
Don't look at the dollars of that. I need to scale this up.
Right. Okay.
But yes, ideally we'd be trading with a portfolio of say 25 to 30 different markets, or maybe more markets, not just Forex, CFDs, indices, etc., all offering these correlation benefits. And yeah, we certainly get very good results that are in line with the fund managers' returns that they're achieving. But it is definitely achievable within our retail world, but you must be patient. You cannot expect instant gratification, because we never know when markets are going to trend. We are at the mercy of the markets here, but we just know that with the liquid markets that we are trading, there are trending opportunities. We can never guarantee when they're going to occur, but when they do occur, we ride them.
Good session, Mitch.
Okay, mate. Thanks very much, Fred.
See you next time.
See you next time. See ya. Bye.
Bye.